terms of today, we're going to cover quite a few things. So I'm really excited. Yeah, this music's not doing well for me today. I'm just going to stop it. But yeah, I'm really excited for today because today we have Phil Grant in the house. I've known Phil for quite a while now. But before we get into that, there's a few things that for those of you who are watching either the recorded version or attending today and seeing us for the first time, I just want to introduce you to inspire a little bit what we do. But as you can see, we love doing workshops. We've got another workshop coming up as well during this tax planning season, we call it, between April and June. The next workshop is actually really, really soon. We have it on the 28th of April, which is actually tomorrow. So if you can join us from 2 to 4 p.m., there's going to be a little bit more about how you can legally save tax for this financial year. We're famous for doing this. This thing called Day for Dollar. So where we essentially save our clients at least 18, we've already saved our clients up to $18 million in tax and counting. So every year when we do a tax saving workshop or a tax planning meeting, we add to that tally of saving our clients that tax. Now, and I say we're famous for doing this thing called a Day for Dollar. Now for every dollar in tax that we do save our clients, we also give life-changing help, access to food, water, health, and sanitation as well through our partners at B1G1. They're a really cool initiative, and we're really proud to say that we've given at least 80 million days of life-changing help there. But yeah, and as usual, you know, we have a team of accountants behind us, but not today. They're not joining us to answer questions. Phil and I will be your main point of contact, but if you need to get in touch with us, if you're interested to find out more about what we do, we'll post up some links after this. Now, who are the people on the screen? I'm going to shamelessly introduce myself. My name is Riz. I'm one of the associate partners and general manager here at Inspire. I've been in industry since kind of 2014, really, but 2016, I started my career as an in-house accountant working with some of the businesses around Brisbane. And yeah, I find that accounting is a great way to get in touch with people and really understand how we can help them achieve their financial goals and dreams. So, or as much as this sounds weird, but I do love accounting. And in 2021, I was proud to say that we were able to save our clients quite a bit in tax, which is just over $2 million in tax. So I'm looking to beat that this year if we can. But yeah, enough about me. The star of the show today is actually Mr. Phil Grant. Now, Phil here, you know, he's actually, I've known Phil for quite a while. Back in 2000, I'm pretty sure it was 2015 or 16, I met Phil. But as you can see, Phil, you might have seen his name on those for sale or for lease boards out in Brandale. He has a nickname of the King of Brandale as well. He's a sales and leasing agent with a really famous brand called Harcourts. He started his career in 2002, and obviously he's an expert in this area. He's got a lot of wealth of knowledge there. Now, in when I met Phil, he's working in Harcourts. I can tell you, he's the guy that is the first to show up and the last to leave. Works bloody hard and has a high care for his client. But yeah, Phil, did you want to just say a quick good day and introduce yourself?
Yeah, thank you everyone who's watching today. I really appreciate the opportunity to work and obviously have this chat with everyone and hopefully instill a little bit of the knowledge that I've managed to gain over the many years that I've been doing this. And I've tried to keep it as simple as I can because you know, it can get quite complex, this commercial real estate world. But look, feel free to ask me any questions you want and I'll do my best to answer them.
Yeah, and that's it. Like, if you guys have any questions, Phil's been in this I call it commercial property space for quite a while. So the golden nuggets are really rattling around in Phil's head there. So if you guys have any questions about anything to do with commercial property, buying, leasing, please drop them in the Q&A box. You should find that at the bottom, and we'll try to answer them during the webinar itself, or maybe towards the end, where we're going to save some time for some Q&A as well. But yeah. Let's see, got Bo in there. Yeah, we've got a few messages. If everyone could use that chat or Q&A box as much as possible, that's where you're going to get massive amounts of value from this webinar today. Cool. Enough about it. Let's say, Phil. Let's jump straight into it. There's a few things we want to cover today. Now, there's kind of five main dot points that we want to cover today, and the first part Phil will take us through a little bit about the commercial property space and how to invest in it through his experience. Phil, is that the three dot points that you want to just run us through those three things there?
Yeah. Look, so the first one obviously is, some of the differences initially between commercial property and residential. And again, I've kind of included it as pros and cons, but I just really wanted to use it as also the main points of difference between the two. So if there's anything there that I go through, just stop me and ask those questions. The second point is obviously, if we are covering those points, what are we going to actually look for when we're trying to invest? Not everyone wants to invest in commercial real estate because they don't know anything about it. So hopefully I can point out a few things that might help. The case studies are the two most recent ones that I've just done to really show you some ideas and, what to look for and put, I guess, an individual strategy for yourself to get into commercial real estate. And then obviously, Riz and I were just talking about, a lot of people are actually leasing, they've never bought. So I just thought I'd cover off really quickly at the end, just some of the little things to start doing to really prepare yourself to get into actually owning commercial real estate if you're currently leasing it.
Oh, that is some meaty stuff there. We're going to try to pack that in this next hour. Well, an hour, 50 minutes. So we're going to try to move through that as quickly as possible. Now, the last two dot points, you might have seen this if you've been to some of our webinars, but we're going to talk about asset protection and some of the tax advantages that we have with the different ownership structures. Now, I've asked Phil actually just before the webinar, hey, what's some common questions, in that space? Like what do people really ask? What do people really want to know? Or what do people consider when they buy commercial property? And a lot of it is to do with the asset protection, the structures and the tax advantages and the do's and don'ts behind that. So yeah, we're going to run through that as well, specific to the case of commercial property. With that in mind, Phil, do you want to take us through the commercial property versus residential pros and cons?
Yeah, no dramas, and apologies in advance for my voice if you're struggling to hear me. Again, just shoot the question through and say repeat what you just said because it makes no sense to me. But yeah, apologies in advance for that. But again, with this part, I guess I asked my dad a long time ago. I was like, Dad, you got a couple of residential properties. Why don't you have a look at commercial? I'm an agent. I can sell you something. I know someone. And he goes, why would I do that? Like, I don't know anything about it. I just wouldn't. Yeah. And it made me really realize, a lot of people own residential property. They bought one because that's a great Australian dream. They want to invest in it. So they do that. That's the second one usually. And then at some point, we look at the opportunity of going, how do we diversify our investment strategies? And one of those is commercial real estate. But the biggest thing that's holding people back is really the knowledge. So this slide's more around some of the major points of difference to really take into consideration when you're going, hey, I've got one investment property, or I got two, or I got 10, but I don't know anything about commercial. So if we have a look at the slide there, we'll start with the first one. Lease terms and length of terms. Generally the residential, you do a 6 month or 12 month. Now we're in a super lucky period where it's, people are generally prepaying and they're doing 12-month leases, right? Yeah. So landlords are loving it. They're sort of rubbing their hands together and going, this is great. With commercial though, typically those leases are a lot longer. So from an investment strategy point of view, you can almost call it a set and forget to some degree where, they might do a 3-year lease. They might do a 10. We've just done a deal with someone up in Hervey Bay. They've signed up a 10-year straight lease with a 5-year option. So the owner of that property can now look at it and go, hey, I've got this income for the next period of time while that lease is signed, all things going well. So, that is one major consideration. Generally, the leases are a lot longer. Big area of concern for a lot of owners, and something that I try and educate people on in the next point is vacancy periods. With residential property, there's a lot of people looking for residential property. Again, the market's like so dynamic at the moment that, every property that's come up for rent will have, in some cases 10, 20 applications to rent it. Now, obviously with commercial real estate, you're at the mercy of a lot of environments, and that can really be something that you've got to be conscious of as the investor, that, should it be a time period, longer than a month, as an example, can you actually afford that? How long can you hold a property for before you are financially going to be in a bit of stress? So, with commercial real estate, if you had asked me last year, how long would it take for you to release a particular property? Depending on what type it was, it could be 3 months, it could be 12 months. Yeah. Now, we're in a different market right now. We're actually saying, hey, depending on the type of property, we're up to 4 weeks. The other day, we listed a property and leased it by Wednesday. So we listed it Monday, leased it on Wednesday, which is unheard of. So, these are some of the things that you got to take into consideration when investing. But I would always sort of say to people, make sure you can afford up to 6 months worth of no rent.
Great.
Otherwise, you're going to be in a little strife if you think things are just going to happen like they do residentially.
Good little that's a golden nugget right there, guys. So that's awesome.
Yeah. Capital growth, real big, it's a question I get all the time, how much capital growth am I going to get with commercial real estate? Well, it really depends on the type of property, depends when you bought it, depends, how you're buying it. And, it depends on a lot of factors. But, if we put it simply, well, residential typically has a steady growth. I mean, I think we're on depending on which source you look at, it's like a 6% annual increase every year on the last 25 years for residential. The last year, in some instances, we've been 30 to 50% increase just in the last 12 months. Commercial real estate, like if we look at a stat, if you had bought property in and around the GFC, that was probably the highest pricing point we've seen commercially in quite a long time. We're only now surpassing those prices. So it actually went down in some cases, and it's slightly come up now to a point that we're seeing prices exceed what the prices were paid in 2007 and 8. Just when the GFC was sort of occurring. So, again, it comes back to making sure that when you're buying, whatever the time period is, you're making a calculated decision based on the information you have in the marketplace at that point in time. So, capital growth for commercials typically been lower, but the returns generally are higher.
Yeah, awesome.
Need to move to the next slide. No dramas. Cool. Yeah. There's quite a few points that I'll get into in that, if anyone really wants to. But one of the major things I'll just say with that is make sure you understand some of the technicalities around the leases. It's one of the major contributing factors to price when you're actually determining your purchase opportunities here between commercial and residential.
Yeah, and I think it makes a big difference as well. Like I like that you've put tenants in there as well, because that makes a big difference, because living in the property, it's really hard to say that there's a big varying range of tenants or type. Yes, there might be different type of jobs or whatever the tenants are in. But here you can see there's commercial, industrial, there's so many options. Hey, and it just depends on those type of tenants. And that sometimes is not an immediate thought when you go, I want to invest in property. Oh, wait, the tenants can be totally different. Depends on what you're looking for. So there could be a range of different types of properties. Like you wouldn't build an office in a 3,000 square meters warehouse, like it's totally different. So there's actually different classes within that asset class as well. Really, really interesting, Phil. And yeah, and I think there's some key things there. You mentioned knowledge. Yeah. And I think you're right. You're absolutely right. I've had a lot of clients, in fact, say, do you know anyone that's doing commercial? I've had a few people jumping into it, but a lot of it, they had to learn themselves, or they had to kind of do a little self-study, where in residential, it's, you've done it before, you've rented before at some point in your life. So you really know that. So commercial is something that if you want to get invested in, it's something that you need some expert advice and expert guidance on, because it can be quite a jungle, as you can see. Awesome, Phil. Yeah, we'll keep running through, because I don't want to lose out on some of the juicy stuff that we have after this. But yeah, what's this about, Phil?
Yeah, so if we just go to the next one, mate. Some of the major things that really need to be taken into consideration when you're looking at commercial investments is the fundamentals. What are the fundamentals around a good investment? It's got to be a good location. If it is a tenanted investment already, make sure that you've done some research on the tenant. Are they a good quality tenant? Are they a local mum and dad business? Are they a national? Are they an international? Is the building you're buying easily relatable? So let's just say that it's already got the tenant and you go, yeah, that's a really good return. But let's say the tenant does move out. Is it something that has been specifically designed for that tenant and going to be very hard to relet? Or is it something that's fairly generic and you can relet it really easy? Is the business that's in that investment property downturn proof? I'd use that as a generalized term, but if the business world goes terribly, like we've had a tough run for the last couple of years, depending on which industry you're in, is it a business that will survive that? And if it is, that could be a consideration for you to look at. And obviously, I briefly mentioned Riz mentioned it, sorry, that you've got different sectors. You got industrial, you've got commercial, retail. Well, retail sector in the last couple of years has been absolutely smashed. The commercial sector, if we look at offices, they have had to sort of evolve. Are they working from home? Are they working from the office? Are they working from both and switching? And industrial property, well, out of the three, that one's been the one that's actually been what I would consider downturn proof at the moment in some instances, where people are now basically dealing third parties. So product will come in, product will go out, or services will come in and out. So it's the one that's seen probably the most change and growth in the last couple of years than the other two. But it's definitely, those are some of the things you got to look at.
And when you say industry, is that like manufacturing and third-party leasing and
warehousing?
Sure. Like
and looking at the environment at the moment. I mean, like a lot of people aren't going out to buy from a retail shop, so they're buying online. Online places don't just magically turn up and deliver stuff to your house. They've got to have a warehouse, right? So that's there. So it's definitely something that you got to look at the moment. And if there's a tenant in there, there's some of the considerations that people don't even think about. They just go, oh, I'm getting a good return. That's great. Fantastic. Let's buy it. But, hey, it might not be the best opportunity.
That's great. And we have some clients here who actually have their own businesses as well, that might rent in there as well, which is, whether it's downturn proof. I guess that's something different that you have to assess where that's your business performance. But I guess looking at if you're buying that property, who's going to be in there? It's a really important question. I can see how there's so many different more levels than a residential property here.
Yeah. And it can be like extremely complex, and it really depends on how far you really want to investigate into what you're buying. And I've said to quite a lot of investors sometimes, like, you'll go down the road and, you'll just look at a review online quickly and you'll go and buy your dinner, right? And you might spend $100, $150 on a dinner, no questions asked, whatever, you'll do that. Or you go and buy $60,000, $70,000 car, but you'll do all this research under the sun to go, yeah, is that the best price I'm ever going to get? Is that the car I want? But then people turn around and they go, someone goes, hey, this is a good investment. And then they go and buy it. I'm like, hold on, you're about to make one of the biggest decisions of your life, and you haven't even gone through all the information to make sure that you're protected. It's pretty nuts to hear, and especially in the market we got at the moment. I mean, people are just buying left, right, and center. I just urge people to do as much research as they possibly can.
Yeah, and I think there's some success stories that we're going to see after this as well, Phil, which is, with good research, you can see how it can work really well for you as well.
Oh, 100%.
Yeah.
100%. And I'll probably finish this slide off with, just check as much as you can what you're actually buying, do your research. And, if something's too good to be true, I can almost guarantee you it's going to be. There'll be something in a lease that will, come back to bite you later on, that you go, oh, but it's a great lease. And I mean, if I briefly tell a story, one of my clients asked me to sell a building. He lost 25% value from when he bought it to when he sold it, because they'd built in a fit out rent into the rent and he didn't even know.
Oh, goodness. So the value, just to kind of, I like examples like that because it clicks in my head what to look for. There was a rent for the fit out itself.
Yeah. So essentially, very quickly, the rent was, as an example, $30,000 a year. He bought it on a yield of the 30,000 and paid whatever it was. I can't remember, about 450,000. When we went to relet it, he goes, well, I want 30,000 a year. And I was like, mate, you're never going to get it. It's only worth about 20. So we struggled to rent it out at 20 because of the fit out rent that they'd built in. He didn't know. And I think from memory, it was like 375,000 or something we sold it for. And that was still a really good price. So
that lease. So it sounds like a lawyer is really important in this transaction, Phil.
Oh, a lawyer, just research, look at it, go, there's a clause that specifically said that there's a fit out built into this rent. And they didn't look at it at all. He just saw the yield and went, yep, that's great.
Cool. And tell us a little bit about this. Looks like the listing classes here, by asset class here.
Yeah, so I'll just, again, just on a bit of education information. This is a slide that I just wanted to include. It just shows what people are actually searching for at the moment from a sales perspective. So if they're looking to buy, and then also if they're looking to lease, what are the hottest categories at the moment? So on the right there, you can see that the offices and industrial are the two biggest searched criteria at the moment, followed by retail. And then on the sales side, our biggest criteria searched at the moment in the northern regions of Brisbane, that is the industrial property, which probably backs up what I was saying before around the industrial sectors being the most significant sector at the moment.
Wow. That's really cool snapshot, because even looking at commercial property, it's so much more than that, and you can see the kind of varying listings that you're having. Is this from commercial? Oh, CFC. Okay, I see.
Yeah, commercial real estate started. Yeah, so just one of two major websites we use to advertise, but it's a good statistic because obviously this will also show you the investor or user demand, which also would contribute to the prices currently being paid by different people for different types of properties. So if a tenant's looking and we've got a large supply, large demand, but a limited supply, obviously we're going to be seeing the pricing structures change, which is where we're at the moment.
Yeah, I see. Cool. Awesome. And yeah, I think you're quite excited to share some stories, some wins that you've seen in the past, and hence why I love Excel sheets, because I'm an accountant. There's a bit of numbers here, but Phil, just checking you can control that and see if you can take us through this case study here.
Can you see that there?
Yeah, that's moving.
Okay, cool. All right, so this is a very simplified spreadsheet that I use just to show an example of one of two situations we've been in recently. So this is a property that one of our owners was basically selling, and as you can see here, there's 4 units in place. They just left the tenants there, so they're all on month-to-month leases. So there's no security at all for the owner, right? Because there's no leases; they're just there. There's only 2 tenants though occupying this building. Now on face value, they're getting $120 a meter. It's really good, right? Well, they're actually gross rents. So out of that, we've got to take our outgoings, which is here. It means we're only getting about $95 a meter in rent for these particular units. Now, this is what we're getting at the moment. So they're getting about, $100,000 a year in rent. If you look over here though, and if you're uneducated, you might go, well, actually, we're getting $125,000 a year in rent. Well, no, you don't get that. That's not in your pocket. So the only number I want to know is, what am I getting in my pocket? 99,000. So when we did the analysis on this property, we realized not only is there no leases in place, so there's no security for the tenants. So obviously the tenants that are in the room, please don't hate me for the price changes that are occurring at the moment, but there's no security for the tenants. So if an owner wanted to give you 30 days notice, see you later, mate, you're gone. I'd hate to know that businesses are running like that, because it doesn't protect you. But also the tenant can give 30 days notice to vacate. So hey, it's a win for you guys as well. But if we did a quick analysis here, the market rent, if I'm being conservative, is 110. If I'm being a bit bullish, is 120. Now, I'll just use the 120 as an example. In this particular scenario, renegotiate these leases to $120 a meter plus all of the expenses. We're now at 125,000 net to the owner. That's what they get in their pocket. And when you go to sell it, we're selling, let's say 5.5%, 6% yields. That's these type of properties. You can see down here that the differences in value is astronomical, between where we need to be. So if we're selling them at 5.5%, we're at $2.28 million, compared to the 1.659 we're at the moment.
Yeah. And just taking a little bit of a slower step there. And this is going back to, hey, I've never looked at commercial property. You're saying that the price is related to the yield. Is that right?
In this particular case, for this property, 100%. So for us to reposition this property for the owner, renegotiate all the leases, put them on 3-year leases or longer, which is the case, the average cost to an owner is only $6,000 to $12,000, but we're potentially increasing the property by $400,000 to $600,000.
That's insane, and that's inherently because, again, not like a residential property. The lease has so much weight in the value of the property itself. So it's magical to see how this renegotiation exercise shifts your equity up by $400,000. That's insane.
Yes. And owners sit there and they go, well, look, my tenant's been fantastic, like this owner did. I don't need a lease. They've been paying rent on time for the last 20 years. Well, what happened was when they went to actually sell the property, it was actually detrimental because the banks don't like the fact that you've got no leases in place. They didn't realize that the rents they were charging were actually, $26,000 a year less than what they should have been charging. And the $26,000 a year, when you yield that out, well, that's actually your difference right there. And that's the thing that people don't understand, is that they might not want to do anything at the moment, but if they either want to refinance or they have to sell, this process can take 4 weeks, it could take 6 months, but there is like $500,000 value there that these owners are missing out on just because they're being lazy, or they just don't want to have that tough conversation with their clients.
And that's such an interesting bit. I'm still going back to residential and commercial here, and because we're looking at different asset classes, there's a few more levers. It's almost like a quasi business you're running here, right? There's a few more levers that you can pull. Then let's say if you had a business and a job, for instance, as a business, there's more levers you can pull to make more profit versus a job is a salary. So I don't know if that's a good analogy, but I'm seeing here there's things that you can be proactive about and do renegotiate, make sure there's a lease in place, maybe in the first instance, and renegotiate that as well.
Yeah, and I'll just quickly, and you can go to the next slide, and I'll go on that. But Gary just asked a question around yields. Typically industrial yields, if we'd gone back 2 years ago, we would be looking at 7 to 9% returns on some particular types of property. That has slowly tightened, and we're now in a position where we're looking anywhere from low 4% yields, and rarely, unless you're in a regional location, are you seeing up to 7% yields, which would reflect a lower sale value. So a greater return, lower value. Hopefully that answers your question, Gary.
Thanks for the question, Gary.
Okay, cool. This was an awesome one. I loved it. This is a particular client of ours that bought a property on market. So it was actually put out to market. He bought this property. Now, again, I won't run through all of these. Can you see that?
Yep.
I won't run through all of these things. However, what you'll see here is, again, the current net position was only 97,000. All the tenants were, they were over here on monthly leases. Like, I couldn't believe this. But we renegotiated this particular property to $125 a meter. We increased his net position by $26,000 per annum, which, if you just look at these two numbers here, the purchase price, 1.835, that's what he paid. The resale value immediately was 2.35 million. So he's made an increase in $522,000 in the space of 4 weeks. Now, when we look at the yields, the situation with this particular property was, he paid 1.835 million. He was only getting a $5.32 million return. 5.32% return. That was his yield. So a lot of the prospective purchases and the things to look out for investors was we've got month-to-month tenants. We've got a lower than normal market rent, and the yield was very tight. So I looked and went, mate, that doesn't really make any sense to pay that money at that yield. However, if we reposition the entire property, we lock all the tenants in 3 to 5 year leases, and we get 120 to 125 a meter, well, guess what? We're now at a 6.75% return. So without him doing anything at all, his return on his money per year went up by what, 1.4% roughly.
Yeah, that's insane. And is this obviously this is 1 unit, but this is a fairly passive investment, that they're not involved in the day-to-day running of the property at all.
So we renegotiated everything so that we actually manage the property on the owner's behalf. He literally checks his bank account at the end of the month to make sure the rent's there, and his statement to say that everyone's actually paid their rent. That's it. So this particular gentleman has, in this particular case, now got a completely passive investment. The tenants are now locked in for between 3 and 5 years. And there's a diversification of income there with 6 tenancies. So should one go south and fail, we've still got 5 more paying the rent. So the worst off he could be, is around 19,000 a year or 20,000 a year that he will miss out on. So, we've really looked at this one and went, hey, you're investing close to $2 million. But, we've got a really good array of tenants here that if things go bad, the limited time on market would be, 4 to 6 weeks maybe, and you might be out a couple of grand. That's it.
I see. And it's, again, each unit is so important to look at who's going to be occupying those units as well, isn't it?
Yeah, 100%.
And those leases as well. It's crazy. It's such a mix of basically asset class in an asset class, almost, if I could use that analogy.
Yeah, massively. And there's a lot more information in there. And I mean, the other thing to look at, that the owners were running it with combination of leases that had net leases, which means rent plus outgoings, and also gross leases, which means the tenant just pays one rent. And the one thing that's happened in the last 5 years with commercial real estate is the cost of ownership has actually, increased substantially, in some case tripled what it used to be 5 years ago. So if the tenant's paying one amount and the owner's absorbing the outgoings, and that's actually increased, well, the owner's now getting a lot less. And you'll see, I'll just click on unit 5 here. That one in particular is probably an example where these ones aren't quite at the right rental rate because of either there being a net rent or gross rent. So, you got to look out for some of that stuff, and it's a great opportunity to reposition yourself as an owner to get a better return.
Very cool, Phil. Awesome. Let's keep moving. We've got a few more things to go. But yeah, this is a common question I get from our clients as well, because a lot of businesses that have commercial spaces they're leasing right now, they probably want to own in the future as well. They have the goal to buy a commercial property on their own. Tell us a little bit about how does someone kind of buy their own commercial property?
Yeah, look, I get this question a lot. I've tried to just keep it super simple this time for you all, and obviously happy to answer any questions anyone has. But the biggest thing about commercial real estate, you probably would have gathered, it's information. The hardest thing about commercial real estate is lack of understanding. So, people go, I've got a business, I want to lease. They go and sign a lease because it's very transparent, it's flexible. If you're a tenant, your goal and dream that I've realized a lot of people want to own their own property, which is fantastic. But there's a couple of things you really need to consider before you buy the bullet, because once you do that, guess what? You're locked in. You're now a property owner, you're a commercial property owner, and you're stuck with whatever that asset is until you decide to sell it. So, are you wanting to own it, or do you like the idea of it? So, you got to understand what your short-term and long-term growth strategy is. Obviously, your accountant, financial planner, solicitor, your business partners, you have those tough conversations to start. Where do we see our business in 3 to 5 years time? Is it something that we're going to outgrow this particular premises that we want to buy? Because I've seen a lot of people go, yeah, I want to own my mate told me I've got to buy something. So I bought it. A year down the track, they've outgrown it. And now they've got to figure out, am I now going to be a commercial investor who wants to rent out his property? and now can't buy because all my money's tied up in the property? Or am I going to sell that and then have to lease or buy? So, make sure you understand what your growth projections are as best you can in the environment so that you can make a conscious decision about buying. Research. Hardest thing to do with commercial real estate is finding information, because it's not as readily available as residential real estate. So, biggest suggestions I can, obviously talk to your local real estate agents who specialize in what you're looking for. It's critical. Don't go and talk to your mate unless he does that. Don't get that advice unless they specialize in it, because you can get the wrong advice. If you want to get on and have a look at different places, go to commercialrealestate.com or Real Commercial and start seeing what's available. Get your head around, the pricing, the sizes, the locations, the distances, the things that are relevant to your particular business. Those two websites will be a great starting point. And then obviously go back to those agents. What do they sell for? How much are they? How long are they actually sitting on the market? Because that's your next problem. If we're in the market we're in the moment, I get calls all the time saying, hey, I want to buy something. The property you've got listed at the moment is awesome. It's going to take me a month to set up my self-managed super fund though. I'm like, sorry, mate, this thing's going to be under contract within a week. So, have the chats with your advisors, all the relevant advisors. Make sure those ducks are in a row so that when you are in a position to buy and you've got that research, you are actually capable of signing a piece of paper. How many times I've had a conversation this year with people who have not had everything ready? I don't know, I lost count, and I feel sorry for them because, I really want to help people go from leasing to buying. But the market is so dynamic that you have to have everything ready to go. So my biggest tip, do not rush into anything. I can't, reiterate that enough. Do not rush, but do not put it off forever. Go and have those chats with your advisors, have your research ready, get everything sorted. And at some point, based on your affordability and your research, just let's go, do it, and you won't regret it, especially with interest rates the way they are at the moment. Hopefully your business is, downturn proof, as I called it before. And, you can actually, strive through that. But if you're buying the right thing, it won't really matter because we'll be able to lease it out to someone else anyway.
Yeah. And then that's really cool because like, I think there's a distinction, right? Like I love my analogies. I don't know if you can tell, but there's a distinction when you're leasing or buying. You're saying like that flexibility. I'm going to go back to like residential terms to relate it. It's like being you're renting or buying your own home. That's the same thing. But the difference here that is if it's your business that's leasing, you're the tenant in there. That's the big difference, right? Like you live in the property that you own. But understand that if your business outgrows it, for instance, funny enough, Inspire is actually going through that right now. But if your business outgrows it and you need to find somewhere new, the analogy I can say is maybe your family is growing, you have more kids and you have to find somewhere new straight away. Understand that sometimes it might not be the forever solution. You need to think a bit more long-term. How many kids, how many employees, I guess. I don't know if you want to relate to that analogy.
I've told a lot of people over the time to, who've wanted to buy, I've said, if your growth pattern is as strong as you're telling me and you've evolved so much, you need to actually consider to potentially look at just renting again for a 12-month period, even though that can be a costly exercise on its own, and then look at buying, do the next jump and then jump again and buy there. Because, depending on where you're at, it is a big decision. It can actually slow you down a little bit to your business side of things.
Massive. And it's, you got to almost think of it separately, right? Like that's a investment on its own.
100%.
Then just I want my business to be in that.
And some big businesses, some international companies, and I've had plenty of these conversations. Well, some of them will never, ever, ever buy their own property because the return on that they're actually getting from their business is far greater than the return they will ever get from the property.
Interesting.
So they will never, ever buy it. But then I've got other people like, well, if you're paying rent, you might as well own it. And then you're paying yourself off and, we're getting a return there as well as the business. So, everyone's got a different strategy. You just got to find the one that works for yourself.
Absolutely. Thanks, Phil. I'm getting a bit of a nudge from Rose here to keep going.
Sorry, guys.
But look, dude, we can talk about this for hours, right? It's some interesting stuff, and that's the thing. We only have 50 minutes or so together today. But yeah, I'm really interested to kind of learn more and also share more with people that we have on the call today, and maybe the wider public. But yeah, thanks, Phil. And if you guys have any questions for Phil, if it's not something that you want to that you're not sure, or you just want to ask questions, I'm pretty sure similar people have the same questions as well. So feel free to drop it in that Q&A or in the chat, wherever it is. We can answer it on the fly, or we can answer it towards the end for Q&A. But I'm going to switch gears now. Into what we call the tax and accounting side of things. So obviously, Phil has brought to the table the expertise about commercial property. Now, the frequent question, like I always say, that's what kind of structure should I be buying? My investment or commercial property in, and the answer is, again, different strategies, different ways to do things. Obviously, it has to suit you. So I'm going to give you a bit of a rundown on what's the best way, what's the best structure in terms of asset protection and also tax planning as well in a bit. But first and foremost, we need to have a kind of overview understanding that there's 4 different types of business structures available to us: an individual or sole trader or individual, company, a trust, and a self-managed super fund as well. Now, I'm not going to spend too much time diving into it, but on a high level, you can see that as a sole trader, we don't usually recommend doing that. And if I could actually kind of direct you to that bottom X there that says asset protection, that's probably one of the biggest reasons. You can see that as an individual, there's actually quite a lot of risk involved, because if you get in trouble with whatever you're investing in and you get sued, or a tenant sues you, you just don't want to be an individual or a sole trader, because your personal assets get actually taken into contention as well. Now, for a company and a trust, that's like a tick with an asterisk there, and I'll explain the asterisk in a bit, but it creates a level of protection, because when you own assets in a company or trust, there is a company or trust is treated as a separate legal entity. So they're almost like their own person if set up the correct way. That's why it's an asterisk there. You got to set it up the right way, not just set it up. So when you buy investments in, or even if you want to run businesses through this, it creates a level of asset protection, but you got to do it right. Now, for an SMSF, it's a double tick. Obviously, with the self-managed super fund, it's a little bit more protected. When we talk about asset protection, really, it's about protecting your personal assets outside of this. So things like your personal home or your car or your savings in a bank account that belongs to yourself personally. This is the stuff we want to protect. Now, in a self-managed super fund, what you want to protect is the fund itself. It's for your retirement. It's dangerous, right? If we do things in our SMSF that are risky and our retirement goes bust. Now, it doesn't mean that it protects your return. That's not what it means. It protects the balance of the fund itself. So it's usually quite hard when something's owned in a self-managed super fund. It's actually quite hard for it to be a high risk investment because there's rules in which where you own an investment in SMSF where you can't leverage it to a certain extent, or you can't do risky things, and there's limited recourse to the investments you make. So there's rules around it that make it quite safe, and that's on purpose, because you can tell the government's funding quite a bit of our retirement right now through age pension. You just don't want all this, people with massive balances in their super fund to just go and invest in risky investments, and they have to foot the bill at the end of the day. So those are some high level. I'll come back to the tax planning, tax rates in a bit, but essentially what we want to look for when we own assets is we want to make sure that we own the assets in, obviously, not an individual, maybe a company, trust, or SMSF. Now, when I say we have to set it up correctly, this is what I mean. So risk is considered like in Inspire, we call it the risk continuum. Risk is not like a switch. You're safe, you're not safe. It's like a dial. You can be risky, you can be less risky, or you can be in the middle, or you can be, it just depends. It's like a dial. But the idea here on the left-hand side is an individual, that's the most risky or high risk. And the low risk here is $0, and I'll explain what that means in a second. But you can see that in the middle, it doesn't mean that you're absolutely protected. There is still always a little bit of risk. And the reason for it is there's this thing called what we call a corporate veil. Now, if you have assets sitting in a company or a trust, you want to make sure that that company or trust doesn't attract any risk. Now, if you're having like a commercial property, for instance, sitting in there, and you have tenants that could come after you for any wrongdoings that you might make. What happens usually is it comes after the company or a trust itself. So it doesn't come after you as the director just yet because of this wall, what we call the corporate veil or protection, because you're treating them, any contract that you go into with your tenant, you're actually going into as a company or a trust. That's why you see the company names and trust names. You're not going into as Joe or Bob or Jane into that. But you as a director or a trustee of the trust, you're signing off on that contract. So obviously you're a human being, you're a person, you have to do that. The companies don't have fingers and hands. So someone has to control. So that's an important bit. Someone has to control the company and trust. Now, why I say it's in the middle is because if you don't set it up correctly, there are some things that can pierce through the corporate veil. So a very simple example is, let's say a company, it gets sued, and then they come after the assets of the company. Now, the assets of the company could be a commercial property. Now, what happens is that, yes, they can come after the commercial property, but you want to make sure that if at the end of the day, if you get sued, you can put the commercial property at risk, but you don't want your personal home to be at risk itself. So what you do then is you go, all right, well, you can go after the commercial property, that's cool, but my personal home is safe, unless I do one of these three things. There's actually a fourth item there, but one of the three things here. If I was fraudulent, they can come after you as a director of that company or a trustee. So if you're fraudulent, that's obviously criminal offense. That company is not going to protect you. If you provide a director's guarantee in any shape or form as well, that's usually done in businesses, or if you want to go after borrowings or credit, there's a personal guarantee done as a director that will pierce through that corporate veil as well. They can come after your personal assets. And last but not least is insolvent trading. Now, again, this is more to do with businesses, but if you can't pay your debts on time, now remember that a risk point not only is just the tenants, but if you borrowed money, the banks are someone who could come after your assets as well. But more often than not, the banks will make you sign a director's guarantee or some sort of guarantee to cover their loans. So you can't really get away with that. But this is just to make you aware that if you do any one of those three things, they can come after your personal assets. Now, how do we kind of make sure that that's a little bit more low risk? So when we set up structures itself, what we need to do is we need to look at risk taker roles and asset holder roles as well. So the idea here is that the person who is signing those documents, the leases, those documents, they're the trade director of those entities, or director of the trustee companies. Ideally, they hold no assets itself. The idea there is if they get in trouble, they can kind of turn their pockets inside out a little bit, to a certain extent. So if there's a director guarantee and they come after this director itself, they hold no assets. So things like your family home, or savings in bank account, or shares, investment, any passive investments that you have, you don't want to hold this. Now, as an asset holder, this is the person who controls the asset and holding entities, such as asset trusts and private companies. So you can see that there's a separation of those two people. Now, more often than not, it's usually the spouse, for instance, the husband or wife who is the director is at risk, and that person is on the names as a director or trustee. But the person who controls the asset itself should be someone separate that doesn't have any risk, that doesn't have a target on their back. So the easiest analogy I can explain here is, imagine if you own CBA shares in CBA, you as a shareholder, there's no risk on you as a shareholder, right? So, but the director of CBA, if he or she does some naughty stuff, the director gets in trouble. Now, if CBA gets in trouble, the director gets in trouble, you as a mom and pop shareholder, you're not going to get sued. You just own the shares, you receive dividends. That's the analogy you use here. That's the separation between someone who's a risk taker, who's a director of the company, and someone who just owns the asset itself. So we want to keep that separate. Now, as long as we do that, this is the idea that the risk taker is worth $0, i.e. your personal home is not held by the risk taker, it's held by the asset person. So this creates another level of asset protection, because we know that setting up a company is not enough. you might get attacked by one of these things. We try to make sure that the assets are held in someone who obviously you highly, highly trust and have a good relationship with as well. But that's kind of like a crash course on asset protection. And before I go into the tax side of things, just quickly, how does it really apply? Now, commercial properties can be looked at as an asset itself, a passive asset. So but there are risks, things like creditors, tenants, and things like that. So it is kind of in this middle ground where it's not like a residential property where there's less risk. If you run the, I had a story, a client who, as a tenant, didn't realize there was asbestos in the building, and then there was trouble within the building, and there's asbestos. Phil, I'm sure you would have heard stuff like this happen before, and suddenly they didn't keep a register of the asbestos, and someone was drilling in the roof. Trouble was brewing. So people were starting to get scared. So you want to really consider, again, because commercial property is really different with the risk levels with different tenants and different types of buildings, and the lease itself it creates a different level of risk. You really want to consider who's going to be your asset person or risk taker in that entity that owns it. But yeah, you don't want to just own it in your personal name. No, definitely not. And also, even if you have a company or trust, doesn't mean you set it up right. You want to make sure that you have the right person who's a director or a shareholder of that company or trust. Cool. Now I'm going to talk about tax quickly. We don't have too much time, so I'm going to really try to run through this because I want those questions to come up at the end. Now, when it comes to tax, there's quite a lot of different types of taxes, especially when it comes to properties. There's things like land tax, stamp duty, which is the necessary evil of properties. You do pay some tax on that, but the parts that we can kind of plan a little bit or have a little bit of control over is kind of the federal taxes. This is mainly state taxes, stamp and land tax, but income tax, capital gains, and goods services is all federal taxes. Now, when it comes to income tax, just briefly explaining, that's the tax that you pay for any returns that you make from that investment. Returns like rental income, so commercial income. So you make that returns there. Now, for capital gains tax, as you know, if you sell the property, you make a capital gain and you pay tax on that as well. So those are two different types of taxes. And GST. Now, when you are a commercial property landlord, you actually charge GST on you would have seen in Phil's example, some of them was ex-GST amounts. Now, GST is something that you charge on the rental income itself. So you actually pay GST. If you're a lessor right now and a lessee, if you're a tenant right now, you're paying rent plus GST. You'll see that. So that's something that is inherent in commercial properties. Now, when it comes to income tax, I'm going to mainly talk about, just going to go back to that slide here. I'm going to mainly talk about the trust and SMSF today, because this is typically what we see people own the commercial properties in. There's some advantages to that. As a discretionary trust, it is quite simple. It's quite straightforward to own a property in a discretionary trust. What I mean by simple is as compared to an SMSF or as compared to, like, say, a unit trust, where you want to consider this if you have one family involved, it's a family asset that you want to share amongst your family, where the returns on that investment can be distributed amongst your family, or even the capital gains itself. So there's some ability in tax planning there as well. A discretionary trust, just like an individual or a company, you can access bank funding, you can borrow as a discretionary trust, but you can't use super to fund the purchase itself. And I'll talk, the reason I put in there is because I'm going to run through a self-managed super fund. So when it comes to funding through a discretionary trust, for the deposit, that 30% that Phil mentioned before, roughly, you need to have that cash ready outside a super somewhere to be able to fund part of that property purchase. And to do that is just by lending the discretionary trust some money, and then it can then buy that property through there. Now, the benefit from a tax perspective here, coming back to this slide, is that you can see the trust. It says 0% tax, which is not technically accurate. There's an asterisk there. What it means is you have to treat a trust like a funnel. It actually distributes any profits or income that it makes to its beneficiaries. Now, I mentioned just now discretionary trusts, you can distribute to your family. So you can actually distribute to individuals, but you can also distribute to companies as well. So as you make any profit or capital gain in the trust, you can actually distribute that out. Now, the benefit of that is flexibility, because you can have a little bit of planning, although an individual pays tax all the way up to 47%, sorry, at the top marginal tax rate. The first tax bracket is 0 to close to $20,000. That $20,000 is tax-free. So you can see how you can, with a bit of flexibility, you can plan where your rental income comes through. Now, this plays a big part because your net return on investment, you should always look at after tax net return of investment, not pre-tax, because at the end of the day, you make a return, not all of it is not in your pocket. Some of it goes to the ATO. So if you have a really good investment structure, you can plan for that tax. Hence why there's some ticks here for tax planning. So you can distribute to some your family members, or you can distribute to what we call a bucket company. So a bucket company, I should say, pays a flat tax rate. Now, if you run a business, a small business, it pays 25%. Now, if you're just receiving passive trust distribution income, it will be coming through the company itself, and you pay 30% tax. So a trust can distribute to those two. So you can see the flexibility. Again, there's no kind of straight cut answer here, but that's what keeps a discretionary trust simple, is that you can own it in trust, you can have your family have access to it, and you can even build in estate planning considerations, who's going to be controlling this asset if it's a long-term hold as well. So there's some really cool stuff you can do there, but you can see the flexibility is the best thing. Now, sometimes that's great when we're not 100% certain what we want to do with the asset just yet. Flexibility is the best. And as Phil said, with commercial property, there's so many different things that can change as the property goes along. Now, sorry. So the next slide here is about self-managed super fund. Now, the reason why there's a bit of a typo there, sorry about that, but self-managed super fund is a great way to invest as well. And obviously you have to look at this from just a structure perspective. What I mean by that is a self-managed super fund, you can actually have up to 6 different members. So what that means is your family members can join together and buy a self-managed super fund if you guys dump enough money in there. What I like about this super as well, you can actually borrow money to buy commercial property. And Phil said, you have to get your ducks in a row quite early to do this stuff, because the way to get money into your self-managed super fund is to actually dump money in or roll your super fund from your retail fund into your self-managed super fund. Now, obviously, that does mean you're selling investment. You're changing your asset class, because when you're in a retail fund, you invested in something. You're now investing in commercial property. Make your research and do your due diligence on that one. But all I'm saying is that's where some of the sources of the funds can come from. So your contribution can come from your business, your personal money, or even investments that you might have sold outside of super. You change it into cash, you put it into self-managed fund. And then if you have enough deposit, you can then borrow for it. Now, the important thing as well is you can't borrow to bill. You have to buy a single acquirable asset. You can't borrow to bill on a land itself. So there's rules around that. So it's important to understand that you really need to know how much your super fund can actually borrow and how much deposit you have in there. Now, some planning that we do with our clients is making sure if they have a long-term plan, let's say 2 to 3 years, is where Phil said, get your ducks in a row. If they want to own a commercial property, it actually takes time to roll money in, because there's limitations in what you can put into your self-managed super fund as well. So it might not be as quick as you think. So if you're goal setting and you're like, in 12 months time, I have a commercial property, speak to your accountant. It might be a lot longer than that, just depending on what your position is at. So as early as possible, if you have that thought and you're interested in that, have that conversation as early as possible, because all this stuff takes a bit of time to build up as well. Now, why do we like self-managed super funds? Sorry, we're going a little bit over time. This is the last slide, but if you guys can stick around for another 2-3 minutes, that's cool. If you have to go, that's cool as well. Thanks for joining. But with the tax side of things, it really is a good tax environment, the self-managed super fund. So I can only speak from that perspective. If you have an asset class that has the same yield, the return on investment, just because it's in the self-managed super fund, it actually returns a better yield after tax. Does that make sense? So if you're outside of super and arguably you earn some income, you have a middle bracket tax marginal rate, inside super, you're going to pay the returns, tax on that returns at 15%. Now, it says that when you're accumulating, so this is when you're not retired, your self-managed super fund is still accumulating money for your retirement. So during that time, your investment is all paying 15% tax. Now, the downside of it is people say, Riz, if it's in self-managed super fund, if I sell it, only 60-year-old me will get to access that. That's true. The single purpose of a self-managed super fund is for you to for you to build a retirement fund. But here's the difference with a residential property. Here's a quick one. With a commercial property, you can actually occupy the commercial property with your business. That's the difference. You can actually use that. Now, if you bought a residential property in a self-managed super fund, you can't use it because you're enjoying it before you retire. But as a business, because it's a arm's length transaction, it's actually a business renting it. You actually have to have your own lease agreement. You can rent from your own commercial property, even though it's owned in SMSF. So technically, although you might be able to invest in it and you think it's all locked away, if you have a business that you want to rent from that property itself, you can actually have access to that. So that's a slight kind of difference there. Now, the other reason why it's attractive as well is when you're drawing down your super, or when your super turns into pension mode, what happens is all the income that's returned in that self-managed super fund pays a 0% tax rate. So it becomes tax-free. So if you have a really long-term plan, and most commercial properties I know, they own it for a very long time. So and I've seen them build, Phil, you can attest to that as well. Like, they build quite a few commercial properties within their family group. And if they held it in super, you can see how any returns that's made once they're retired, it's actually an attractive way to hold investments, because then your return went from paying tax at 15 to 0%. It's definitely beating any other investment outside of super. So it's a cool way to do that, but obviously there's rules around it, which I'm not going to go into detail with today, but that's the reason why SMSF sometimes is really attractive as well. That goes the same with if you sell the property. So you can't retire with the property. You need cash to retire because you stop working, someone needs to feed you. If you sold that property, the capital gains on that is at 0% when you retire as well. So in Phil's example there, it's 400-500 grand in uplift and capital gain that they make. Insane. If that was tax-free, all in your pocket. Now, I have to be very, very careful when saying this. There's a lot of cowboys when we talk about self-managed super fund out there. If you're non-compliant super fund, you get in trouble because the ATO has some strict rules in how you can use the funds in the super. Obviously, just don't go and set up a super fund. Like what Phil said, people just buying and not really thinking about it and just doing it the way they like to. Speak to an accountant, speak to an advisor. If you need to speak to us, we'll post some links after this, but definitely make sure that your super fund's compliant. It's there for your retirement. If not, you pay 45% tax and some penalties as well, which is not a lot of fun. You don't want to be this plane. That's not a fun plane. Cool. That's pretty much all we have today. I've gone a little bit over time. Phil, you did better than me in terms of timing, man. Like, you were like on point. Rose is about to kick me off the webinar now. But yeah, it's been a pleasure. We do, Phil, do you have a couple minutes still, maybe for some Q&A that we have here?
Yeah, you're right. Yep.
Yeah, cool. Yeah, I'm just going to leave this slide up. But if you guys have some questions or anything that you guys want to talk about, Phil's here for the next 5 minutes, 12:09. So please feel free to drop any questions that you have. I think there was one before. So we've got Gary. You see that one, Phil, there? Gary says the rule of thumb for yields for different types. I don't know if Gary's still around there. I assume that means different types of properties.
Okay, yeah. Like, is there rules of thumb for different asset classes potentially? So, look, the old rule of thumb, is, industrial property was the one that would give you the greatest return because it was considered high risk. And, you would typically look at instances where the yields would be 7% at their tightest. And in some cases, 10, 11%. Now we're looking at positions at the moment where industrial is sitting at 5%. And if you're lucky, you might find something at 7%. Now, that's probably probably for industrial, you're probably looking at 5%. With the retail market at the moment, there's no real rule of thumb with that at the moment, and probably same with industrial. It's a case-by-case basis, but if I can give you a range, at least you're working within the parameters, which for retail, it depends. Is it a local tenant? Is it a national and international? If you're a local tenant, you could be sitting somewhere again, around 5% to around 6.5%. If you're looking at a larger tenant or a national or international, you could be down as low as 3.5%. We've just done a $20 million transaction at 4.19%. So, we're looking at a super tight yield, but that income's somewhat guaranteed for a substantial amount of time. So they're happy to get a lower yield. And office space is somewhat similar, but I would dare say I'd be wanting a higher yield. So if I was buying commercial office space at the moment as an investment, I would want to be sitting around 6 to 8%.
Yeah. Okay.
Very hard to find though.
Yeah. I think that's it's a case by case basis, but it's good to see there's a difference. First of all, like there's such a distinct difference between those two, between those three different examples there. Cool. Thanks, Gary. Angela, what strategy can be made if the commercial property to be purchased for owner occupied as office? What strategy can be made? Well, we might need a bit of clarification what you mean by strategy can be made. And again, if it's something that we can't answer just because it's too specific to your situation, guys, please feel free. We're going to post some links in here to book a strategy call with us. And if we need to answer some of those questions, or we need to rope Phil in with some of the questions that they're looking for, feel free to drop us some calls there. Now,
I'll just make a brief thing on that, Riz. Like a strategy is somewhat similar to what I mentioned before around your research. Whether you're an investor or owner occupier, you still want to make the same considerations with what you're doing, because even if you are an occupier, at some point you have to understand that you may not be there anymore. You may outgrow it. You may sell the business. You just may want to, I don't know, you might want to close the business down or sell it off and they move it somewhere else. So when you're looking at the strategy, the fundamentals are the same. Is it a good location? Has it got good car parking? Is it near public transport? Is it something that I can relet? Is the price that I'm paying or looking to pay, a good price? I mean, there's a million different things we've got to look at, but it's all about, like, think about the end, so that when you do start, how things are going to happen before you've got to that point. So I can relet this when I sell it, or, I can relet this when, I need to grow again and move somewhere else. It's keep the end in mind when you start. It's a great way to look at it. Not everyone does it, but the same strategies. Look at the fundamentals. If you tick the fundamentals off, you put yourself in a really good starting position.
That's great. That's a great piece of advice there, Phil. But yeah, I think we've gone really good in terms of timing with the Q&A. It's 12:09 now. But if you guys have any other further questions or anything that you didn't get answered, or because there's a lot that we can cover in this stuff, right? Feel free to reach out. I love this type of webinars. And Phil, thank you so much for joining us today. You've been amazing, mate. And
no problem at all, guys. Thanks for having me.
Yeah, no, that's all good, guys. And thanks for the team, Tay and Rose, for organizing it as well. I hope to see more of this. This is exciting, Phil. Thank you.
No dramas. Anytime, guys. Thank you very much. I really appreciate it.
Awesome. Thanks, everyone. We'll see you at the next one. Tomorrow there's one. Check it out. See ya.